The UK housing market just delivered some shocking news that nobody saw coming. In September, average house prices dropped by nearly £800 in just 1 month. Now, before you start celebrating or panicking, let me tell you why this single data point could be the canary in the coal mine for something much bigger happening to British property. Here's what's really going on. The Halifax Index shows the average UK home price fell by exactly £794 in September alone. That's a 0.3% monthly decline that caught many experts off guard. But here's the kicker. This happened right after prices had been climbing in August by 0.2%. So we're seeing this back and forth movement that suggests the market is genuinely confused about where it wants to go. The annual growth rate has also slowed dramatically, dropping from 2% in August down to just 1.3% in September. This brings the typical UK property value to around £298,000. But if you're looking at London specifically, you're still staring down prices averaging over £500,000 at £543,000. Now, you might be thinking this is just normal market fluctuation, but let me show you why this could be the beginning of something much more significant. Multiple industry experts are pointing to warning signs that suggest this isn't just a blip. First, let's talk about what's driving this decline. The employment market has been weakening steadily, which directly impacts people's ability to buy homes. When fewer people can afford mortgages, demand drops and prices follow. But there's another factor that's creating uncertainty: the looming government budget announcement. Buyers are literally holding back their decisions because they don't know what policy changes might be coming. Sarah Coles from Hargreaves Lansdown made a particularly striking observation. She said the market may not be going anywhere fast for a while, and that the uncertainty around the budget is putting buyers off entirely. This kind of market paralysis often precedes more significant price movements. But here's where it gets really interesting. We're seeing conflicting data from different sources, which actually tells us more than consistent numbers would. While Halifax reported this price drop, Nationwide Building Society recorded a 0.5% increase for the same month. When major housing indices can't agree on basic direction, it usually means the market is at an inflection point. The mortgage situation is adding another layer of complexity. Although the Bank of England has paused interest rate hikes, lenders have been nudging mortgage pricing higher as they rebuild their profit margins. This creates a squeeze where buyers think rates should be stable, but the actual cost of borrowing is creeping up anyway. Karen Noy from Quilter Wealth Management pointed out something crucial. Inflation remains well above the Bank of England's 2% target, keeping borrowing costs elevated. Even though swap rates have drifted lower, lenders are preparing for potential surprises in the upcoming budget by increasing their margins. This is particularly hitting first-time buyers who are extremely sensitive to rate movements. Here's what makes this situation potentially explosive. We're seeing a perfect storm of factors converging simultaneously. Higher supply levels are putting downward pressure on prices. Buyers are becoming increasingly cautious as the budget approaches. Mortgage costs are sneaking higher despite stable base rates. And the employment market is showing signs of weakness. Tom Bill from Knight Frank delivered perhaps the most direct assessment, saying sellers are getting the message that house prices are under pressure. He believes prices will continue to dip modestly before ending the year broadly flat. But here's the thing. When experts predict broadly flat markets, they're often being optimistic about avoiding sharper declines. The regional breakdown reveals some fascinating patterns that could predict where the market is heading. London and the South East, traditionally the most expensive areas, are showing the weakest growth rates at just 0.6% and 0.2% respectively. Meanwhile, northern regions like the Northeast and Northwest are still posting growth rates of 4.8% and 3.9%. This north-south divide isn't just about affordability. It's about where economic pressure hits first. London's property market often acts as an early warning system for the rest of the country. When London prices start struggling, it usually indicates broader economic headwinds that eventually spread nationwide. But let's talk about what this means for different groups of people, because the impact isn't uniform. For older homeowners planning to downsize, this stagnation is genuinely concerning. They've been counting on their property values continuing to rise so they can cash in their equity. Sluggish price growth means their retirement plans might need serious adjustment. First-time buyers, on the other hand, might finally be catching a break. The typical first-time buyer home costs around £236,000. And if price growth continues to slow, that target becomes less of a moving goalpost. However, this benefit only materializes if mortgage rates remain stable and employment stays strong. Current homeowners are feeling a psychological impact that goes beyond pure economics. When house prices are rising, people feel wealthier and more confident about spending money. When prices stagnate or fall, that wealth effect reverses, leading to increased caution and reduced consumer spending. This creates a feedback loop that can amplify economic slowdowns. The government has announced plans to shake up the home buying system, potentially reducing costs for buyers. Changes include requiring sellers and estate agents to provide more information up front, reducing the need for expensive searches and surveys. They're also considering binding contracts at earlier stages to reduce chain collapses. These reforms sound positive, but they're also an admission that the current system is broken and contributing to market dysfunction. When governments start intervening in property markets, it often indicates they're concerned about broader economic stability. Industry professionals are reporting interesting dynamics on the ground. Jonathan Hanford from Fine & Country says good homes are still moving quickly when priced realistically. But there's room for negotiation that didn't exist before. Amy Reynolds from Anthony Roberts confirms that competition remains strong for the best properties, particularly where stock levels are limited. This suggests we're seeing a bifurcated market where quality properties in good locations maintain their appeal, while average properties face increasing pressure. This kind of market segmentation often precedes broader price adjustments as the premium for quality locations eventually gets tested. Looking ahead, several factors will determine whether this September decline was a temporary blip or the start of something bigger. The autumn budget announcement will be crucial. Any policies that impact property ownership, capital gains, or mortgage relief could dramatically shift market dynamics. Interest rate stability remains essential for maintaining current demand levels. If the Bank of England needs to raise rates again to combat persistent inflation, the mortgage market could face another shock that pushes more buyers out of the market. Employment trends will be equally important. The UK job market has been showing signs of cooling, and if unemployment starts rising significantly, housing demand will face sustained pressure regardless of other factors. So where does this leave us? The September price drop might seem small in isolation, but it's occurring against a backdrop of multiple warning signals. We have conflicting data from major indices, increasing buyer caution, creeping mortgage costs, weakening employment, and policy uncertainty all converging simultaneously. This combination of factors suggests the UK housing market is entering a period of genuine uncertainty where small monthly changes could accumulate into significant annual movements. Whether prices fall substantially or simply stagnate will depend on how these various pressures play out over the coming months. For anyone considering buying or selling property, the message is clear. This is not the time for complacency. The market dynamics that supported steady price growth over recent years are shifting, and the September decline could indeed be the start of something much bigger than a simple monthly fluctuation. The next few months will be absolutely critical for determining the direction of UK house prices. and everyone with a stake in property should be paying very close attention to these early warning signs.